GOOG. I currently hold Alphabet, and I think it's overvalued. So I want to see if it's ripe to sell. And I bought it. I typed it so well. Around 90, which was around 2023, around here. And it's currently 235. So it's up quite significantly. And to me, I think this is a little overvalued currently, and it could be a great way to de-risk my entire portfolio and basically sell the business and take out some cash that we could reinvest, probably possibly in Lululemon, or have a few other stocks I want to take a look at. One of them is Accenture, another one is a healthcare company making cutting edge cancer medication. And now we want to look at it from another perspective. When I bought it, I already said, okay, this is a great business. I bought it for a great price, and I could, at that point, relatively reliably predict it for the future, mostly because I could buy it for very cheap. Now the price is absolutely off the charts. They're currently at I think their all-time high or near their all-time high. Yeah, no, they are at their all-time high. So we're in uncharted territory. We don't know how high this can go. It was very downbeaten because of the everybody talking about ChatGPT and AI taking over and Google search being dead in the water and being replaced by ChatGPT. They've continued to show good growth numbers. They've continued to show that they can actually make money from their users, whereas most AI models have not yet found a way to reliably generate cash for themselves. But I do see the future around the corner. How much more can they grow? And is this the best investment for my cash right now? Is there not a better opportunity for me out there? The business is no longer depressed, it's doing great. Let's take a look. Now, if we look at our due diligence, they make search engines, cloud services, and AI products. Their business is built on innovation and technology. They earn money through advertising, cloud services, and AI solutions. Their competitive advantage, they have a strong moat. Yeah, Google is a verb. Everybody knows Google. I think there's no denying that their moat is strong and still going strong. Their AI models like Gemini are widely adopted, giving them an edge. The earnings call highlighted robust growth. Take a sip. In search and YouTube, driven by AI features that enhance user engagement. They are positioned as a leader in the digital space. Alphabet shows impressive compounding momentum. Google's cloud revenue run rate exceeds 50 billion with a 17% operating margin. The earnings call noted significant growth in YouTube, especially with shorts and sports content. Their focus on AI integration across products promises sustained growth. Management emphasizes expanding AI. This is interesting because the current winners of AI are NVIDIA and most data service centers. And Google is on the software side and on the delivering of their AI product. Now they have managed to commercialize their search engine and make a lot of profit in doing that. But on the AI side, it requires a lot of investment for them to make it profitable. And this could mean that all their cash is being pumped into their AI capabilities without direct return for me as an investor, as a stockholder. That comes with short-term risk of not getting any money on your investment. But for the long term, they could still position themselves as one of the biggest players. So I'm still quite torn whether I should watch how this case plays out or whether I should cash out now and find a better investment. They plan to enhance AI mode and integrate AI into more services. The earnings call hinted at strong demand for AI-driven solutions, indicating a bright future for Alphabet as they continue to innovate and adapt. Yeah, they're heavily investing in AI, crucial for future growth. I think that's undeniable. The question is whether or not I want to be the participant of the investment round or whether I want to find another place to store my cash in the meantime, and then I'll come back when they're bigger and better and more operationally efficient, and I'll buy them back at a later point. And at that point, they would have already done the investment. We can see whether or not they're operationally efficient. Bless me. Whether or not they're operationally efficient. And at that point, it becomes a better investment. There's less risk. It's a more sure business case. Right now, there's there's still a lot of uncertainty whether or not they will come out on top and they will actually manage to monetize the huge amount of capex that's currently being invested into AI. Google Cloud is rapidly expanding with a strong revenue trajectory. Yeah, I think that's still a big revenue driver. Robust user engagement in search, and YouTube highlights their competitive edge. Yeah, I think search currently is quite big. I think more and more people will pivot to AI, but Google has their own AI model, Gemini. So maybe they manage to keep a lot of the users. And then it's still the question, how are they going to monetize it? I think YouTube, I think it's a great platform. I see continued growth there. It's not slowing down. So my perspective, this is still, there's no competitor to YouTube. So this is a solidified mode. Now, if you look at it from a revenue perspective, they continue to grow, but the growth is slowing down. Free cash flow perspective, they continue to grow, but it's slowing down. Return on invested capital is still very good, and actually they managed to increase it recently. Cash to debt is still very good, so they can make their capital expenditures into their AI capabilities, and they have recently bought back a lot of shares. Now I think they were absolutely cheap, so a great business decision to spend cash on buying back your own shares. If we look at it from their latest return on invested capital, it has increased even more to 25.8%. That's what I like to see. The return on equity, the return on assets, return on capital expenditure, are all very, very high. Gross margin of 58%. Now, for a software company, that's relatively low. Their operating margins are then very strong, and their net margins are incredibly strong, 28.6%. I think this is the highest one we've seen today. Debt to equity, this is all looking very good. They do pay out a small dividend, which is also very sustainable. Now, let's look at what we have always looked at. Cash in short, yeah, we already know this is beyond positive. Let's say it's 100,000 rounded out. Short-term debt, 0. From a liquidity perspective, perfect. So they can absolutely put this cash to work, invest it into AI. From a cash flow perspective, let's look at the free cash flow. Without looking at it too much in detail, I would expect it to decrease the last few periods. Oh, no, it hasn't. It's still increased. I would at least expect their capital expenditure to grow. That has grown quite significantly. But they still managed to grow their free cash flow. Income-wise, growth, 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 growth. They're not slowing down at all. Woo! Crazy, 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 crazy. They've 5x over the last 10 years. Earnings per share has grown massively as well. Okay, so it's still a great business. The first question, is it a great business? Yes. Then the price. Right now we want to see the inverse. We want to see it highly overpriced. Let's take a look at our DCF calculator. Let's say best case scenario, they keep investing, but they manage to do well in the AI race, and they keep growing at 20% for 10 years, which is really, 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 really good. Especially given they're already such a large company. If they manage to do this, I'm willing to pay 30 times earnings. Now, let's say they're able to grow 15%, 10 years. I think that's still relatively good given their size. But I would be willing to pay a little less for that. And then for 10% revenue growth, I'm willing to pay market average. And then we want to have a 15% return. It's overpriced by 20%. So yes, right now could be an interesting time to sell, but it's not massively overpriced. If we do it based, we just did the calculation based on their earnings growth. Now, if we do it from a free cash flow growth perspective, it's even more overpriced. And from a dividend, yeah, they barely have any dividend. So this would massively they don't have any dividend at all. So it's still overpriced by about 20%. Yeah, I'm going to be very not optimistic. That's not the word I'm looking for. What am I looking for? Opportunistic. I'm going to be very opportunistic, and I think I'm going to hold on to it a little bit. Maybe we can eke out. Let's see what it is. It's still on a growth trajectory, so it feels wrong to sell right now. So I'm going to add it to my watch list, and probably at the bottom, I might sell 250. Feels like a great number. Could it reach 300? It could, but based on my analysis of how I look at a business, it's not worth 300. So it would be entirely opportunistic to hope for it to go to 300, but it would not be based on any actual analysis and fundamentals, and it would be I would let emotion take control over something that we know might never reach it. And 250 is already a great price, so 250 it is. That's my number. That price I wanna sell.